Okay, let's unpack this. Imagine a huge healthcare company, right? Hospitals, services all over the place. They put out their latest report card. But what does strong growth really mean when you're that big? And what are the challenges maybe hiding behind those good numbers?
Today, we are really digging into HCA Healthcare, specifically their second quarter financial performance for 2025. We're mainly looking at their recent earnings call, the highlights, and the reports that came with it.
Right. And our job here really is to pull out the most important stuff from those numbers.
Uh,
What they're doing strategically, how they're handling market pressures. The idea is to give you, the listener, a kind of shortcut so you don't just know what happened, but crucially, why it matters. We're trying to spot the key trends, what they mean for healthcare overall. Yeah, that's exactly it. We want you to walk away with a clear picture, concise but still deep, of where this major player stands. Give you some context for whatever your interest is, professional or otherwise. So, okay, diving into those Q2 2025 numbers, HCA put up some, well, really impressive figures. Their diluted earnings per share, basically profit per share, it shot up, what, 24% to $6.84. That's huge. And revenue saw a nice bump too, up 6.4%. From your perspective, what were the biggest things pushing these numbers up? Anything surprising in there?
no huge surprises in the drivers themselves. It was pretty clearly more demand for services, which is good. And an improved payer mix. That just means, more patients coming in with better paying insurance. Plus, patient acuity, how sick the patients are, stayed pretty consistent. You see this across the board. Equivalent admissions were up 1.7% for the quarter, 2.3% year to date. What's really interesting, though, is managed care equivalent admissions. Those grew by 4% so far this year.
Ah, so that's the private insurance piece really driving things. Exactly.
It shows their strategy to optimize that mix is working. They're pulling in more of those commercially insured patients, which, is a real advantage in today's market. And this strength, it feeds into profitability too. Their adjusted EBITDA margin improved by 30 basis points. That's 0.3% versus last year. And overall adjusted EBITDA grew 8.4%. So better core profitability.
Okay, strong top line, strong operations. But what about, the underlying financial health? Their balance sheet. I saw they pulled in $4.2 billion in cash flow from operations. That's a lot of cash. And they're putting it to work, right? $1.2 billion in capital expenditures, buying back $2.5 billion in shares just in Q2, plus dividends. And it all led them to actually raise their forecast for the full year. Now expecting revenue between, $74 and $76 billion, and EPS between $25 and $57. That sounds like they're pretty confident.
Oh, absolutely. That level of cash flow combined with how they're managing capital, it paints a picture of a company that's not just growing, but strategically reinvesting and returning value to shareholders, obviously, with the buybacks and dividends. That roughly $5 billion they planned for capital spending for the whole year, it's not just keeping the lights on. It's a calculated investment in specific high-growth areas, making sure they have the capacity where the market's actually expanding. Like we saw increased spending on cardiac devices, which points to expanding those services.
Right, right. But, it's never all good news, is it? Even with this strong showing, HCA mentioned some headwinds, like Medicaid volumes dipped slightly, and self-pay was lower than they expected. Those are their lower paying categories, correct?
That's right. Those are the ones with the low reimbursement rates.
So how are they tackling that? And what's happening in the bigger picture that might be causing it?
Well, that brings up a really important point about the broader landscape. HCA does anticipate some folks might lose insurance coverage. A big part of that is the upcoming expiration of those enhanced premium tax credits. The subsidies helping people afford insurance on the exchanges.
Ah, the ACA subsidy.
Exactly. If those go away, it could definitely impact their numbers. And then there's legislation. They mentioned challenges from that package, sometimes called the One Big Beautiful Bill Act, potential hits from certain Medicaid rules, exchange provisions, basically new regulations that could squeeze government payments.
Okay, so federal policy uncertainty, potential coverage losses. That's a lot to juggle. And they even mentioned, sort of, localized issues, underperformance in a couple of markets offsetting gains elsewhere. Plus, supply costs ticked up a bit, mainly because of those cardiac devices you mentioned. When they talked about updating their guidance, especially with that new Tennessee program DPP and the admission numbers, what did the CFO, Michael Marks, actually say?
Yeah, these are definitely real pressures. They affect patients and the company's bottom line. Marks explained the $300 million guidance bump. He said it's split pretty evenly. Half is from state supplemental payment programs like that new Tennessee DPP you mentioned. Then basically extra state funding expected to bring in cash later this year. And the other half, just better than expected performance across the rest of their business, their portfolio.
Okay, so the core business is still strong enough to offset some specific weaknesses.
Right. And the adjustment on admissions, he clarified, was specifically tied to those lower Medicaid and self-pay numbers. But the overall portfolio is holding up well. It shows they're finding growth, even when some traditional areas are pressured.
So even with dips in those specific payer types, how are they managing to, keep the overall engine running, especially with potential policy storms brewing? What are these resiliency programs Mark's brought up?
Yeah, it sounds like they're being quite proactive. When asked about those programs, especially thinking about the subsidies expiring, Mark said HCA is actively working on ways to offset any negative impact. Things like benchmarking corporate departments, looking for efficiencies, focusing on operational improvements, using more automation, digital tools. They said they'll share more details later, but it shows they're not just waiting to see what happens. And, looking at commercial volumes, managed care admissions being up 4% year to date, that fits their plan. Exchange volumes are doing a bit better than expected too, even if traditional commercial is a little softer.
Hmm. That point about inelastic demand is interesting. CEO Sam Hazen said healthcare demand seems pretty stable, right? Not really affected by consumer confidence dips.
Yeah, that was his take.
Is there a risk there? Relying too much on that assumption, especially if the economy really tightens up.
It's a fair question. Hayes' point is that healthcare isn't like buying a new car. People generally seek care when they need it, giving HCA some stability. That's a definite strength. The risk, maybe, is if something fundamentally changes that pattern, like a huge policy shift, or if out-of-pocket costs get so high, people do start delaying care significantly. But for now, their data suggests things are holding steady. He also pointed to continued market share gains, suggesting their investments in networks and capacity are paying off. Despite competition, they seem pretty confident about where they stand and their ability to adapt.
Okay, so let's try and pull all these threads together. What's the big picture takeaway from HCA's Q2? How does it all fit?
I think the real deep dive insight isn't just that HCA had a strong quarter, but how they managed it. It seems to be this balancing act, right? They're aggressively investing capital where they see high demand, but at the same time, they're building these resiliency programs to guard against those big policy headwinds, almost like stress testing the business for future shocks. I mean, the numbers themselves were solid. Q2 2025, that 24% jump in diluted EPS to $6.84, revenue up 6.4%, driven by that demand and better payer mix. And like you said, they raised the 2025 guidance, expecting revenue between $74 and $76 billion, EPS between $25 and $27. That's a strong signal.
Yeah, and what's fascinating, like you said, is doing that while clearly dealing with real challenges. We talked about the slight dip in Medicaid and self-pay, the looming tax credit expirations, the potential impact of that legislation. But their strategies, the $300 million guidance boost split between state programs like Tennessee DPP and general portfolio strength, developing those resiliency efforts with benchmarking and automation, really highlights how adaptable they're trying to be. Plus, they're pouring money back in, $1.2 billion capex in Q2, planning $5 billion for the year, big share buybacks, dividends, all while cash flow from operations stay strong at $4.2 billion.
So what's the bottom line for you listening? It means understanding that even in healthcare, which seems stable sometimes, things are constantly moving. You've got shifts in patient demand, payer mix changes, complex laws, local market stuff. It all demands real strategic agility from these big players.
Which does raise a pretty important question, doesn't it? As companies like HCA focus on their own resiliency programs to handle policy shifts and market changes, what bigger innovations might be needed across the whole healthcare system? To make sure access to care is sustainable and equitable for everyone, especially with all this ongoing uncertainty around insurance and government programs. Something to think about.